Welcome back. In the first part of Chapter 16, we examined what constitutes a gain and what constitutes an ordinary gain versus a capital gain. In this unit, we're going to look more deeply at capital gains and losses and how the proceeds from such activities get reported on the federal tax return. We're also going to look at other types of investment activities, including real estate investments and passive investment activities. We learned in the first part of Chapter 16 that ordinary income comprises ordinary dividends and ordinary interest, whereas a capital gain is generated from the sale of a capital asset. If multiple groups of investments are sold within a year, some netting a gain and others netting a loss, the loss can offset the gain. A net gain occurs when the sum of all capital gains and capital losses results in a positive cash flow. The net capital gain is included in adjusted gross income, but it's taxed at the preferential capital gains rate. The net loss for individual taxpayers results in a limited deduction from the adjusted gross income calculation. There are also short-term and long-term gains and losses. Short-term gains and losses are losses or gains that are realized on an asset that's been owned for less than a year. This includes the write-off of non-business bad debt. A long-term capital gain or loss is a loss or gain that's realized on assets that have been owned for more than a year. This information is reported on Schedule D of 1040. The first part of Schedule D reports the short-term capital gains and losses. The net of short-term gains and losses is reported in line 7. And any losses carried over from prior years is reported in line 6. But we'll talk about this carryover provision in a little bit. Part 2 of Schedule D pertains to long-term capital gains and losses. And again, the net long-term capital gain or losses are reported in line 15, and they are offset by any long-term capital losses that have been brought forward from prior years. In total, capital gains are the net of short-term gains and losses and long-term gains and losses. Short-term gains are taxed at the same rate as ordinary income. Capital gains on 28% rate assets or special collectibles are taxed at a 28% bracket. All other long-term gains are taxed at the taxpayer's qualified dividend income rate. These range from 0 to 20%, and the qualified dividend rate is a function of one's adjusted gross income. For married persons, $3,000 of capital loss can be deducted during the year of loss. This amount is $1,500 for married persons filing separately. The remainder of the capital loss can be carried forward indefinitely to offset future capital gains. So you might ask yourself, why are capital gains given this preferential treatment? Why are they taxed at a lower rate than our normal income? And there are several reasons why the tax code makes this exception. First, the tax code requires that capital gains be taxed when they're received or when they're earned. If you had taxed on the incremental gains or losses while holding an investment property, including stocks and bonds, this might result in gains some of the time, but losses some of the time. By taxing when you dispose of the assets, rather than during the periods of incremental gain, your taxes should be higher. Second, taxing when you dispose of the assets can negate the effects of inflation. Some gains are merely a function of the rising cost of living. By taxing at final disposition, it helps to assure that assets are being sold in the interest of making a profit or avoiding future loss. And finally, tax at disposition encourages the mobility of capital. By taxing at a lower rate, it encourages investors to sell the assets, to make more money, and generate an income tax transaction. If the income tax rates were the same for both capital gains and for regular income, there'd be no incentive to sell stocks. So let's check our comprehension of the distinction between a net operating gain and a net operating loss with regard to capital gains. We're looking at Rachel's salary from her big shot Bloomingdale's job. She earns $112,000 salary, and in this year she earns $2,200 in interest income from bonds. She suffered a $15,300 capital loss on the sale of a rental property. So let's figure out Rachel's adjusted gross income and, if applicable, net operating loss carrying forward. Well, first, let's figure out Rachel's ordinary income. She receives a salary of $112,000 and she receives $2,200 in interest income, which is taxed as an ordinary item. So this means that Rachel's gross salary is $114,200. She has, in this scenario, both a $15,300 capital loss and a $10,500 capital gain. So what does that mean for her AGI? Well, we can net the capital loss against the capital gain to determine whether she has a net loss or a net gain. This yields a net loss of $4,800. Since Rachel is an individual taxpayer, she can deduct $3,000 of that loss, which will yield her an adjusted gross income of $111,200. So what happens with the remainder of that $4,800 loss? She can carry that forward to future years to offset future capital gains. This would yield an $1,800 net operating loss carry forward. In scenario 2, Rachel also receives a $16,000 capital gain distribution from a mutual fund. In this case, Rachel would offset the $16,000 gain by the $15,300 capital loss, yielding her a net gain of $700. This would be added to her income for an AGI of $114,900. Finally, if Rachel had no other capital transactions, but has a $17,000 capital loss carry forward from a prior year. In this unfortunate scenario, the net operating loss from the prior year is netted against the $15,300 capital loss that Rachel incurs this year, for a total net operating loss of $32,300. She can deduct $3,000 of that loss from her adjusted gross income, which leaves her with an adjusted gross income of $111,200 and a net operating loss carry forward of $29,300. An individual can also report net income from investments in real property. This can include profits from real estate businesses, which are treated as a business for tax purposes and reported on Form 1040 Part E. An individual can also hold undeveloped land as an investment. Any property taxes incurred on the land are itemized deductions. As with other investments that are financed through debt, the interest payments on mortgages used to purchase undeveloped land can be itemized as well. Another type of investment is a passive investment. This includes joining a business as a silent partner, that is, contributing capital to a business, but not participating in the active day-to-day management of the business. Rental activity is another example of a passive investment activity, wherein the individual generates revenue from receiving rent and is not generally involved in the day-to-day management of the activity. That is, the property does the work itself. Income received from passive activities is considered a return on capital, and loss on passive activities is limited to the extent of income generated by other passive activities. Losses from rental activities, specifically, are limited to the lesser of the amount of passive income, or $25,000. This ceiling threshold gets phased out based on adjusted gross income. A passive loss can only be carried forward as long as the investor holds the asset that incurs the passive loss. So, if you're holding an investment property and generating rents from that property, you can only continue to carry a loss forward until you sell the property. The minute you sell the property, you lose the passive loss carry forward opportunity. So let's check our comprehension of the passive rental loss exclusion under the tax code. Let's assume that now that Ross and Rachel and Monica and Chandler have moved on to new endeavors, that Ross and Monica decide to rent their apartment out that Monica and Rachel had shared. Ross has a half interest in the apartment, and the complex operated at a $53,000 loss during the tax year. Ross earned a salary of $59,000 and received ordinary dividends and interest of $4,400. What would that do to Ross's adjusted gross income? Well, first we figure out Ross's ordinary income, which is his $59,000 salary, plus his $4,400 ordinary interest and dividends. This gives him a salary, or ordinary income rather, of $63,400. The limitation before the benefit of this deduction starts phasing out is $100,000 of AGI. Since Ross's AGI is below this point, he can take advantage of the full $25,000 deduction, or the extent of his passive loss. Since Ross and Monica share this at a 50% interest, his full loss is $26,500. So Ross is limited to the limit under the tax code of $25,000. This brings his AGI to $38,400. Now let's assume that instead, Ross earned a higher salary, a salary of $113,400. What would this do to the passive rental loss deduction? Ross's ordinary income, the net of his salary and his ordinary dividends and interest, is $117,800. So what does this do to his real estate passive loss deduction? We know that it begins to phase out above $100,000. So first, we have to compute the amount that Ross's income exceeds this threshold. In our case, since it's $100K, it's a simple $17,800. The benefit begins to get phased out above this threshold by $25,000 minus the difference between the amount of excess divided by 2, which in this case means his maximum deduction is $16,100. We deduct this from Ross's ordinary income, which gives him an adjusted gross income of $101,700. At this chapter, we examined tax treatment of gains, including ordinary gains from ordinary dividends and interest, as well as capital gains, real estate income, and passive income. This concludes our second module on individual taxation, and in the next module, we'll examine the tax treatment of business activities.